There are three ways to tell if a stock is overvalued or undervalued. Most investors know about the first one. Almost none of them use the third. And the gap between those two levels of analysis. That's usually the gap between guessing and actually knowing. In this video, I'm going to walk you through all three in order and then show you what each one looks like in practice on a real stock. We're using NVIDIA. By the end, you'll have a clear framework for how to approach valuation on any company. Let's get into it. The first method is the one most investors reach for, the price-to-earnings ratio, or PE. Here's how it works. Take the current stock price and divide it by the company's earnings per share. If a stock is trading at $100 and the company earns $5 per share, the PE is 20, meaning you're paying $20 for every $1 of annual earnings. The idea is simple. Compare that number to peers or to the sector average, and you get a rough sense of whether the stock looks cheap or expensive. NVIDIA right now has a trailing PE of 41.2. By this measure alone, it looks expensive. The semiconductor sector average is well below that. Most investors glance at this number and move on, either too expensive to touch or obvious momentum they're chasing. But here's the problem. PE only tells you what the market is paying for current earnings. It says nothing about where earnings are going. A company growing earnings at 30% per year can have a PE of 40 and still be a reasonable deal. Because you're not buying today's earnings, you're buying the next 10 years of them. PE is a starting point. It's the fastest lens you have. But if you stop there, you're making a decision with one eye closed. The second method goes one level deeper, relative valuation. Instead of one ratio, you look at several, P over B, EV over EBITDA, price to sales, and you compare them not just to the market average, but to direct competitors. The idea is that businesses in the same industry should trade at similar multiples, and if one is significantly higher or lower than peers, there's something worth investigating. For NVIDIA, you'd compare it to AMD and Broadcom. NVIDIA's P/S ratio is 21.0. Price to sales, AMD's is significantly lower. So, on a revenue basis, the market is paying a heavy premium for NVIDIA. The question is that premium justified by the quality of the business? And this is where relative valuation starts to show its limits. It tells you whether something is cheap relative to peers, but not whether it's cheap in absolute terms. If the whole sector is running hot, relative valuation just tells you who's the least expensive in an overpriced room. To answer the real question, what is this business actually worth, you need the third method. The third method is one of the main frameworks professional analysts use, and the one most retail investors don't have the time or tools to run properly. DCF, or discounted cash flow analysis. The concept is straightforward. A business is worth the sum of all the cash it will generate in the future, discounted back to today's dollars. A dollar earned 10 years from now is worth less than a dollar today because of inflation, risk, and opportunity cost. DCF accounts for that. In practice, you build a model. You project revenue growth for the next 5 to 10 years. You estimate what profit margins will look like. You figure out how much capital the business needs to reinvest. Then, you calculate free cash flow each year, apply a discount rate that reflects the risk of the business, and work backwards to what the company is worth today. If that fair value is above the current price, undervalued. Below the current price, overvalued. For NVIDIA, the inputs are not trivial. Revenue grew 65.5% last year to $215.94 billion. Free cash flow hit $96.68 billion. The business is generating returns on invested capital of 70% against a cost of capital of 15.5%. That gap between ROIC and WACC is one of the most important numbers in fundamental analysis, and NVIDIA's is exceptional. But here's the barrier. To run a proper DCF on a business this complex, you need to make multiple assumptions across growth, margins, reinvestment, and discount rate. Each input has a wide range of plausible values. Small changes in long-term growth assumptions can materially change fair value. This is why DCF models done well take hours, and it's why most individual investors don't do them. So that's the honest picture. PE ratio. Fast, but you'd have dismissed NVIDIA at 41 without looking deeper. Relative valuation. Better context, but still tells you nothing about absolute worth. DCF. The right framework. But the barrier to execute it properly is genuinely high. This is why most retail investors fall back on shortcuts. They see a PE of 41, think expensive, and move on. Or they see the stock up 200% and think it must be overbought. Neither of those is valuation. This is exactly the problem Invyra was built to close. It does the valuation work, the same logic behind a DCF combined with business quality and moat analysis, and returns one clear output. What does this business appear to be worth, and how does the current price compare? Let me show you what that looks like on NVIDIA right now. I'm pulling up NVIDIA in Invyra. This is live data as of today. The IV engine is Invyra's core valuation model. It analyzes NVIDIA's financials, revenue growth, margins, free cash flow, capital structure, and calculates what the business appears to be worth based on expected future cash generation. The output. Invyra puts NVIDIA's fair value at $239.50 per share. The stock is trading at $202.78. That's a 15.3% discount to fair value, meaning by this model, NVIDIA is undervalued, not overvalued. Now, let's slow down here, because this is exactly the point of this video. The trailing PE is 40.9. On the surface, it looks expensive. But when you account for what this business is generating, $96.68 billion in free cash flow, earnings growing at 30% near-term and 25% long-term, the fair value calculation lands well above where the stock is trading today. There's also a forward PE worth noting, 22.6. As earnings continue to grow, investors buying at today's price are effectively paying 22.6 times next year's expected earnings, which is a very different picture than the 41 number you'd see on a basic stock screener. This is why single metric valuation misleads. The trailing PE said expensive, the full picture says something else. The IQ score weighs valuation, business quality, growth, and financial health into one composite signal. NVIDIA scores 8.0 out of 10. Invyra's composite signal reads strong buy. That's an algorithmically derived label, not a personal recommendation. Looking at the breakdown, durability scores 10.0, as close to perfect as Invyra assigns, reflecting the consistency and defensibility of NVIDIA's business model. Efficiency scores 9.6, momentum 9.5, resilience 8.4. The weakest dimension is clarity at 3.7, which reflects the complexity and uncertainty around modeling NVIDIA's forward earnings, given how fast the business is evolving. That clarity score is worth holding on to. It doesn't mean the investment is bad. It means the range of outcomes is wide, and that the numbers you're working with require more judgment than usual. Invyra's moat score is now confirmed. Wide, 8.2 out of 10. This matters for valuation, because a wide moat means the business can defend its margins over time. NVIDIA's moat is built on CUDA, a parallel computing platform developed over 2 decades that the entire AI and data center industry has standardized around. Developers build on it. Enterprises deploy around it. Switching costs are real. You can build a competing chip. You can't quickly rebuild 2 decades of ecosystem adoption. A business with a wide moat is more likely to actually deliver the future cash flows that a DCF model assumes. That defensibility is a key reason the fair value estimate holds at $239.50 even in a competitive market. One figure I want to highlight specifically, ROIC of 70% against a WACC of 15.5%. ROIC is return on invested capital, how much profit the business generates for every dollar it deploys. WACC is the cost of capital, the minimum return investors require to justify the risk. Think of it this way. For every dollar NVIDIA reinvests back into the business, it generates 70 cents of return. The minimum investors require is around 15 cents. That gap, 70 versus 15, is enormous. Most mature businesses barely clear it. When ROIC runs this far above WACC, it means the business is compounding real economic value with every dollar it puts to work. That's the financial signature of a business with durable competitive advantages, and it's one of the key reasons the fair value estimate lands above the current price. There's one signal worth flagging. Invyra's smart money indicator, which tracks institutional and insider positioning, shows a reading of -36, bearish. Insiders and institutions are currently net sellers. This doesn't override the fundamental picture. Smart money can be wrong, and institutions sell for many reasons unrelated to long-term view. But it's information. The fundamentals say undervalued. The smart money says caution. That tension is worth sitting with before making any decision. So, overvalued or undervalued? By the numbers. The fundamentals support the valuation. Fair value at $239.50 against a market price of $202.78. ROIC of 70% against a cost of capital of 15.5%. Financial health passing all 4 checks, a durability score of 10. Forward P of 22.6. which means if the earnings trajectory holds, you're not paying an unreasonable multiple for what comes next. That's a coherent case, and it's grounded in the numbers, not a feeling. The tension worth holding on to. The smart money signal is bearish. The clarity dimension, the lowest in the IQ breakdown, reflects real uncertainty in modeling where this business goes from here. And at a beta of 2.21, this stock moves harder than most in either direction. That doesn't change the fundamental picture, but it does mean how much you own matters as much as whether you own it. Position sizing is where the real risk management happens here, not the entry price. This is what valuation is supposed to give you, not a signal to act on, but a framework to think from. The numbers are clear. What you do with them is your decision. The three methods I walked through, PE, relative valuation, DCF, are the foundation of how serious investors think about stock value. Invyra doesn't replace that thinking. It does the heavy lifting so you can focus on the judgment, not the spreadsheet. Free for now at invyra.thinkrium.ai. Run it on one stock you've been thinking about.